And thank you for taking the time out of your day to spend it with us, learning about valuation and how measuring the valuation on an annual basis or recurring basis will help you gain financial clarity in making business decisions. So I want to get started. We're going to offer our first polling question. We want to get to know our audience a little bit better. We're actually starting out with 2 polling questions, but we'll start with the first one. I'll introduce myself. I'm Holly Rook. I'm the business valuation leader here at Adams Brown. I've been doing valuations for about 20 years now, and I have a designation as an ASA in valuing businesses, and I just really enjoy coming alongside business owners, helping to uncover and unlock their private company value and their private company wealth. So let's see what everybody said on the polling question. So in the next 3 to 5 years, some of the goals that most of the people on this webinar are interested in is maybe selling to a key employee, and also keep working on the business. Both are very aspirational goals. About 50% of you are there. And then some of you are looking at selling to a third party eventually. So we'll be talking about some more things that go into the sales process. That'll turn over to Tiffany to introduce herself.
Hi, I'm Tiffany. I am a senior staff out of the Wichita office. My designation is through NACPA, and it's just for a certified valuation analyst. And I've been working in valuation for just under 4 years now. And I really just enjoy being able to provide people with the value of their investment.
Let's go ahead and offer our second polling question as we go over the agenda here. So today we're going to be talking about measuring the value of your business, what goes into a business valuation. We'll touch on that briefly. We'll also look at certain KPIs or key performance indicators. We'll consider what drives the value of the company as well. We'll also be talking about our actual case study from a client that is growing and strategically thinking about how to drive the value of their business. We'll be talking about recurring valuations and how that can provide a data input for you to track your annual returns. We'll also be talking about some interesting topics that are new and exciting. One of them is artificial intelligence, how that affects valuations, as well as the tariffs and how some of those challenges and opportunities affect the valuation process as well. We'll offer some concluding thoughts, and then we'll save time for some question and answers. So what is the results of the second poll? Okay, so we have a lot of business owners on this call. About 50% of you are business owners, and some of you are work in the financial space for the company. Some of you just want to understand valuations a little bit further, and then some of you it's not applicable. Perfect. With that, we'll turn it over to Tiffany talking about measuring the value of your business.
So first, on how we calculate the value of a business, valuation itself is a forward-looking concept, and we use 3 particular inputs in order to look into a value, and those are the cash flow, the risk, and the growth. We call these value drivers, and I go a little bit further into them on the next slide. These 3 ingredients that go into every valuation are considered in light of information that we use for your company performance, as well as economic conditions, industry expectations, and so on. When we look into evaluation, there are 3 main approaches. Mostly for an operating company, we're going to be looking at a conjunction of the income and the asset approach. So your income approach, we just use your historical cash flow and we adjust to your future expectations of the company, which goes back into one of your value drivers. And then your market approach, we use what we call reported transactions for both public and private companies. And we apply transaction multiples to these benefit streams. And so when you are looking over the Wall Street Journal and you see that another company has sold, and you'll see a phrase that, oh, they sold for 3.5 EBITDA. That is a market multiple, and that is what most brokers use in order to provide the value of the business.
Yeah, so in addition to that, I will say that both the income and the market approach are synergistic, and in that the three value drivers are very similar and intertwined in both the income approach and the market approach. But in the market approach, it's a little bit more discrete. So in the market approach, one way to kind of uncover the growth and the risk is to consider what the reciprocal of the EBITDA multiple would be. So if you're trading at a 5 times EBITDA multiple, you take 1 divided by 5. That gets you to a 20% risk and growth estimate. And so that's considering that the company has a 20% rate of return and also considers the growth aspect. So companies that trade for a higher multiple than that 5 times EBITDA, those estimates are kind of considering lower risk or higher growth. And so it's just one of the things that we can look at in terms of using both of those approaches simultaneously and making sure that the valuation numbers agree with each other. We really do like it when that.
I was going to say, I really like when the numbers come in close. That's my goal on everything. It just means that they support each other and that the value is the true value that we're coming up with when the numbers are closely aligned.
Definitely.
So we look at what we call an annual return on your investment, because most of the time when people have a business is an investment, but it is mostly not publicly traded on NASDAQ or the New York Stock Exchange, where somebody can actively go out and find what the value of their investment is at each point in time. So a valuation will give information and the value for a closely held business and just give owners the availability to understand what their investment is worth, and they can compare it to their other investments on their personal balance sheet. One of the things that is also really important about closely held businesses, especially service-based businesses, is that goodwill is something that can make up a good portion of your value. For service-based businesses, it's about 80% of the value of your company. And that's not something that's what they call blue sky. It's not something that's easily measurable. It's not tangible. But
and you don't see it on your balance sheet either.
Yes.
So, yeah.
But a key piece of information is to remember that just like any other investment, a business is an investment. And once you're able to understand and track what your value is, it'll make tracking the return on your investment easier as well.
Definitely. So let's go into the value drivers a little bit more.
We have a quick question real quick. What does EBITDA mean and how is it calculated?
Sure, I'll take that one. So EBITDA is called earnings before interest and taxes, depreciation, amortization. So basically it looks at a common measurement of cash flow. And so it's a cash flow measurement without those non-cash expenses. And so it's just a really good indicator of what's distributable from a company at the end of the year.
So, as I spoke to earlier, there are three main inputs when it comes to the main value drivers of the business. You got your cash flow, your risk, and your growth. Your cash flow provides your profitability. It's the most easily controllable portion of this triangle because you can look at your accountability for key stakeholders and having a positive effect on your margins. If you look at your expenses, you can look at both your variable and your fixed expenses. These are things that you can control, and they can either have a positive or a negative impact on your value. As your cash flow goes up, your value increases as well. So things that you can do to increase the value of your company is you can look and see if you have any unused subscriptions that are just hanging out there. You'll see, personally, you'll see ads for things like Rocket Money where they're like, you're going to have subscriptions that are just hanging out there that you have no idea. And after all that, we see that this adds up because now if you have subscriptions to all the streaming services, you're paying more than you would for normal cable at this point. But if you're not using them, then there's no purpose in paying for them. And it would keep you more cash flow positive to eliminate these. On the other
That's
end,
one of the things that we did on our own team is we did look at our technology stack and we evaluated what products we use commonly, and maybe there were some things that we weren't using as heavily in our department, and maybe we could cut back on those or eliminate those altogether. So we did do that, and so it increased the cash flow to the company overall, but I mean, from a team standpoint, it increased the cash flow for our team.
it also increased our efficiency because not having to go through all these different things to get one answer helps out a lot. On the other hand, one thing that could happen is if you run your personal expenses through your business, it not only impacts your bottom line, but it ends up costing you time and money and also on your profitability margin. So if you were looking at your income statement and you see expense for a full personal car that you're not using in the business sense, then you shouldn't have that expensing through your business. Risk is probably one of the things that we talk about most here, just because it is something that you can't avoid. You have what is called diversifiable and undiversifiable risk. Most of the time, we consider the company size, the profit margins, the comparison to industries. There are many qualitative and quantitative factors that go into what is considered risk. One of the easiest ways that you can lower your risk. So on this triangle, you increase your cash flow, it increases your value. When you decrease your risk, it increases your value. So the higher your risk, the lower your value. If you are concentrated into one customer, that's a higher risk, because I've had it to where I've done a valuation where a company had a 90% customer concentration into one client. And the worst thing happened where this client pulled out and they couldn't constitute their cash flow at that point because they were so heavily reliant on this one client to make all of their income. So the easiest way that you can lower your risk is by diversifying your revenue streams, diversifying your clients, going into different markets, or making more products that could apply to other areas. Being less focused into one particular area, whether it's clients, whether it's customers or suppliers or industry, that all goes into decreasing your risk.
Definitely.
And the other end is growth. Growth we measure in both short-term and long-term growth. It is probably the most subjective out of all of these because growth is not easily measured. No one could have seen what happened in 2020 with COVID. They couldn't have foreseen this. And so the effects that it had on the growth of some companies, some did very, very well in COVID and some did not for several reasons. And so you can control your growth by acquiring new businesses or going into different industries or researching an underserved market. All of these things have an impact on your value, and that's why we call them value drivers. So once you understand the industry that you're in, you can then look into what is called benchmarking. And these are used for your key performance indicators. So everybody, each company looks at all the different metrics. There's pages and pages of metrics that people can look at. However, each industry has some specific key performance indicators or KPIs that are more prevalent to them and more important to them. So if you're in the concentration or the construction area, you are very focused on your profits and how profitable each project is, or how often you win or lose a bid, because that information matters to you in that industry. In manufacturing, inventory is a huge portion of what makes or breaks a company. If you have inventory that is just laying around gathering dust, you're not using it, it's taking up space. It's taking up space on your balance sheet. And you should be reviewing your inventory yearly at least to see if there's something that needs to be removed.
Yeah, a couple of other service-based industries, they're going to also be relying on productivity measurements and just utilizing your staff as best as you can, and also making sure that they have enough projects to keep them busy. So in terms of architectural engineering, you want to make sure that those projects that are being managed well, efficiently. Also, you can manage those projects specifically from a profitability standpoint. There's also some other key measurements along with the dental practices industry. So just making sure that those people related costs and measurements are tracked on a maybe quarterly or potentially monthly basis, and just kind of looked at in comparison to a couple of standards. So what would we compare them to, Tiffany?
We would, you can compare them to a couple different things. We can compare them to the industry, because normally when we receive industry information, it's in these metrics or it's in common size multiples, just because that's the easiest way to gather all the information from the available from the companies that are reported. And these measurements being your KPIs, if you look and you see, hey, my inventory turnover ratio is 42.3, but the industry's is 11.6, there's a difference. Obviously, either you're doing very well or you're not doing well enough. Because so for activity-based ratios, most of them, if it's a higher number, you're doing better. And whereas all your other metrics, if you have a lower number, you're doing better. It's kind of, there's switch ups.
It depends on which multiple you're looking at.
Yeah, exactly. But you can also compare to yourself. We get onto it a little bit further into the case study, but we're able to provide metrics for the company as of 6 months ago. And then you're able to take this information and then compare 6 months later and see, hey, my inventory has changed or my current ratio has increased. And so you can see just how you have moved in comparison to yourself, which sometimes is a little bit easier to both understand and to stomach, because you know what you're doing and you know how you have been working and trying to improve, and seeing that improvement helps along the way.
Definitely. So our recommendation would be to consider, picking one or two key performance indicators. You can find these key performance indicators if you don't know them through a trade organization for, if you are in equipment manufacturing, generally there's going to be a lot of trade organizations or one specific one that can help you identify those key performance indicators, and then just start tracking some of the most important or critical ones to your company and make small improvements. Those small improvements can add up to a lot in terms of affecting your balance sheet as well as your income statement. If you're managing your inventory more efficiently, that means your sales you're moving inventory out in terms of sales. So a lot of these key performance indicators, you shouldn't be ignored. You can focus on one or two just to kind of get better and stronger, build your reps, and then kind of work on some other ones down the line. Let's talk about our case study now.
Yeah. Okay, so anyone who lives in Wichita understands just how volatile the aerospace industry is, whether it's in your manufacturing or in the overall industry. Just because we are called the air capital of the world, and aerospace manufacturing and support comprise a large portion of our local economy. So Aeromock Labs is a manufacturing company in Wichita who are solely focused on legacy airplane parts. They manufacture and repair analog dials for the dashboard, where most airplanes now are going towards digital dashboards. However, Aeromock has seen something different. While their market has been shrinking every year, their market share has been increasing because they're one of the only people who do what they do, and they do it very well. The question comes up, however, is how do you measure the value of a company where the market is knowingly shrinking every year? And how do you make strategic plans based off of a value on a very volatile industry?
Yeah. So when we think about our value drivers, definitely one of those was for this particular company, their growth and their risk are tied to diversification through acquisitions. So they've made a couple of strategic acquisitions of other companies so they can kind of spread their manufacturing capabilities over to a couple of other what we call bolt-on companies that just are really good fits for this industry, but also not necessarily playing in the same space.
Mm-hmm.
Yeah, what are some other things that they did, Tiffany?
So Jeff and Gina, the owners, who are the dynamic dream team, like they both work so incredibly well together. They wanted to understand not just what the value of their company was, but how they could make strategic plans and move further down the road. And they started doing recurring valuations. First, we just gave them the initial value of their company, and then we went through during the valuation each owner, they realize that we ask questions in such a way that makes them think a little bit more about why. We always want to know the why, and we want to make sure that other people understand the why behind it. So why do things work as they do? Why are they performing better? What could be done to improve the business, and why? So throughout all of this, it makes owners think a little bit more strategically, understand that, hey, I do this really well. Is there a way that I can improve on this portion of it? Or understanding that they can turn a weakness into a strength by making a few strategic moves. Sometimes turning a weakness into a strength isn't as difficult as it sounds. It's just making a little bit of a change that makes a whole big difference on your cash flow. One of the big things, obviously, this being a manufacturing company, we looked a little bit more into the activity-based ratios and inventory. Jeff even knew, he had said, he's like, I know I have excess inventory. I know I have obsolete inventory. And so originally when did the first valuation, they were in the process of going through all of their inventory and checking it out. By the time that we were looking at it again 6 months later, after doing a write-off of inventory, they were able to see that their metrics have improved. So they are able to compare to their prior valuation and see just what has changed and see the increase in the value on the company.
Definitely. So, I took the numbers from a previous valuation and looked at what the annual return on for this particular company was. A 12% annual return on your investment is a very good return, especially in light of everything that went on through 2020, 2021. And so there's a lot of volatility, but definitely kind of knowing and unlocking that annual return, looking at the valuation from a prior period and just kind of seeing, okay, what happened if it decreased and increased. So let's talk about how you measure your annual returns. So this is just a very hypothetical, high-level example, but whenever we're talking about annual returns, there's two types of returns. I like to say there's the return on and there's return of. So you have one that's your capital appreciation or stock appreciation. That's basically the change in your stock price from one point in time versus the previous point in time. So in this particular example, about a $200 price differential per share. And so that reflects a 20% annual return. And then if you consider that the company paid annual dividends and what those dividends were per share of $50 per share, then that adds on an additional 5% to their annual return. So their annual return is around 25%. When I looked back into 2024 and looked at the Dow Jones index and the S&P 500, last year's annual return for the Dow was 12.9%. And then the prior year, or the S&P 500's annual return was around 23.3%. So it's a good idea to kind of look at the company's value from a year-to-year basis or maybe every other year, and kind of compare that to, if I were invested in the stock market, what would my annual return be if I had not said that I'm going to hold this investment in the company. So it's just a really good idea and another benchmark or another tool that you can use in comparing your valuation to other types of investments. So one of the things that we also do when kind of comparing from year to year is that we can look at okay, what were the qualitative factors or quantitative factors that impacted the valuation? So generally higher profitability, higher cash flow. That's that value driver that we're talking about. You increase that from year to year, then it increases your value. Another key metric would be your debt levels. So by decreasing your leverage in the company, that can have a positive impact on your company's value. So hypothetically, let's just say that this company is in a particular industry that's in a consolidation mode, and maybe buyers are paying a higher price because of that market factor. So when market multiples increase, it translates into a higher valuation for your specific company. And so valuation multiples do increase from year to year. And so looking at what's happening in the market in terms of mergers and acquisitions and things like that, it's just a really good way to understand the market that you're in and just kind of get better understanding of those factors as well. So let's talk about a couple of recent factors affecting valuations. Two really exciting topics for me. Artificial intelligence is, it kind of presented itself in terms of the stock market in 2023. So I think it was the fourth quarter of 2023. You had a lot of tech stocks that their values were increasing. A lot of that was due to just kind of AI. It was a very newer technology, and it increased the valuations for those companies in tech. Let's tie this back to our valuation drivers and just kind of put it into practical use here. So some practical use cases that we're seeing, and I'll start with how our team is using AI on a day-to-day basis. So one of the things that we're doing is helping us to manage our projects better by helping us to be more efficient. So we can definitely utilize it for, we have a technology that takes information from tax returns and puts it into a 5-year historical analysis. So once it does that, we definitely have to double check and make sure that the information was loaded properly. We definitely do a quality control aspect there, but it saves about 2, maybe 3 hours of time on our end. Another thing that we can use AI for, and that we have been using it for, is some research tasks that we do on a regular basis, getting more information about a particular industry, and helping us to understand that industry a little bit better. We have access to a lot of industry information. Some of it is AI generated, but already, but it just helps us to understand valuation a little bit better and to think about it a little bit better. Another thing, I recently had a conversation with Jennifer Allen. She is in charge of our healthcare growth area, but also focuses really in this niche area for dental practices. And so some practitioners are using AI day to day for scheduling, but also whenever you're getting your annual exam, or 6-month exams, and you have to do an X-ray, those X-rays can also be looked at or double checked with AI. So AI imaging and looking for hot spots like cavities or other, serious concerns from your dental aspect. That's just another way that practitioners are getting maybe a second opinion or second look. They're looking at that information and just kind of evaluating the information that they're seeing. So it's just kind of a checks and balances for them. But, you know, in terms of the three levers of valuation, you know, you could see some growth aspect for AI in terms of you looking into additional market shares, what markets are underutilized, what areas can you develop further. Maybe it can even help you identify areas, similar areas that you're not playing in, but are similar but different. So just good opportunities there. Another way is for increasing efficiency. If something like daily tasks takes about 2 to 3 hours for you to do it, but AI can do it in 30 seconds or so. That's a huge time savings, and it maximizes your efficiency. So
I think something, yeah, to remember is that AI, yes, it's new and it's still learning, because I was laughing when Holly was saying that we use it in our department. It's because for some reason they can't spell the word accrued and they can't spell the word liabilities. I
we
don't know why.
definitely have some spelling issues there.
Liabilities goes to disabilities. It's just something that it does. But when I was in university, it was the transfer of technology was coming around a lot more, and my professors were always saying data driven jobs are going away, but it's not that the accounting area is going away, because what it's doing is it's taking the daily menial tasks that, yes, getting information from tax returns for us used to take 4 hours to do all of this, to get all the information. But now I can spend my time doing more analysis and doing things that technology can't do yet. So any way that you can increase your efficiencies, just as if back when they were all introducing using machines to do a lot of the manufacturing of stuff, it is just another way that you can increase your efficiency and help your bottom line.
Definitely. Yeah. And so in our industry, accounting, we work with a lot of private and sensitive data from clients. So in our industry, our firm has set up specific guardrails for our using artificial intelligence. We don't put any information from clients into the AI, like a chat GPT. We would never do that just because it's private data. But you definitely want to understand those risks and try to utilize it, you know, strategically and innovatively, and just kind of think of those opportunities. So there are specific AI gurus in every single industry. One of those that plays in the accounting industry, his name is Brian Statz. And so he provides a lot of great content about how to utilize AI and different tools that you can use in AI to, you know, help you save time and make your practice more efficient. So one of the other areas that I wanted to talk about was tariffs. This is kind of this specific topic really does affect the manufacturing construction industries a lot. And so one of the things that I did this morning was that I asked in Chat GPT, so using AI, what are those 5 key challenges for tariffs affecting manufacturers and constructions, and what are those opportunities? Basically, it spit out a lot of information regarding how these factors are affecting valuations. So some of those things are increase in prices. So, you know, obviously as steel and inputs that we get from the China market, those tariffs are going to come into play, unless they're electronics for China, for example, which has been exempted. But, if you're importing parts as a manufacturer from China, you are going to experience some increased costs. There could be some other supply chain delays or just increased risk in terms of getting those supplies, because if other suppliers are looking domestically to source their materials, and you already have a domestic source supplier, there's increased competition to get those supplies. Another thing that I saw as an opportunity in terms of tariffs is that because of the tariffs, manufacturing is being brought back in to the United States. So it's going to take some time, but we're definitely going to de-risk in terms of our supply chains and getting that information or getting that production from other sources domestically. It's going to take some time, but it is going to provide more opportunities in terms of construction. You're going to see some more expansion in certain markets and new opportunities for growth. So I definitely see it both from bearish side and the bullish side, but there are a lot of key considerations to just think about, and there are going to be a lot of opportunities out there. So let's talk about best practices in terms of maximizing your value. We've talked a lot about risk, and risk is measured through what we call the discount rate in our income approach, and also through the market multiple that we talked about. So when you de-risk your company by diversifying, by making sure that you're not reliant on a key person or some key persons in the company, that has a de-risking factor. I will also say that corporate governance, whenever you have advisory boards or a company that just has a group of people where they get consensus before making strategic decisions, that's a very good sign of a healthy company. And that has a de-risking factor for the company and the company's valuation. So if you don't have that sounding board of people that you talk to before making those strategic decisions, it's a good idea. It's something to implement or consider implementing. Another thing is you want to make sure that your legal agreements are up to date and just making sure that you're protected. So sometimes people, owners don't necessarily think about certain things. We'll talk about the buy-sell agreements and the importance of having a buy-sell agreement in the next slide. But it's, there's definitely those corporate agreements that protect you. Another way to do that is increasing efficiencies, increasing capacity. So by doing that and working smarter and not harder, you can increase your profitability. You can help manage the company in terms of, some of those administrative tasks, some of those scheduling tasks. You don't necessarily have to take a lot of time. Finding innovative ways to effectively find ways to make your company more efficient is definitely a way to maximize your value. So if you have a certain person that just really does enjoy and making sure that the process works efficiently, leveraging that person. identifying that person and just leveraging them to help you maximize that efficiency is a good idea to do.
I mean, another quick way you can manage efficiency is if you use Microsoft Outlook, they've got this thing called Quick Steps. So if you have some consistent emails that you have to send to a team, or it's like a weekly update or something like that, you can set up a quick step. So all you need to do is press a button. It's got the entire email just ready to go, and you can change it up a little bit rather than having to retype it every time. That's one of my favorite things that I've done recently, and I've gotten most of the team to do that as well.
Yeah, that definitely helps speed up time on repetitive tasks that you're doing, just making that process more effective for you. And then preparing for a setback. So I will share this story. So we had two clients that we recently done valuations for, and their valuations during the period from 2001 to 2022, their revenue just went up quite a bit. I mean, they had just a lot of growth. And so I asked them what they did. So what they were in the manufacturing and distribution industries. What they did is they understood just kind of how the shutdowns would affect the supply chains in the future. And so they kind of had this underlying feeling, well, maybe there's not going to be as much in terms of supplies that we need to make our products in the future. So what they did was they acquired and accumulated as much inventory as possible in those first couple of months of COVID. And then when their competitors ran out of supplies and didn't have that foresight just to accumulate those supplies, they were in a very good position because they acquired new clients that were looking for, or new customers that were looking for those same supplies. And then since then, they've also been able to retain those customers. So it was just a really good strategy for them. They thought strategically, and they turned that setback into an opportunity. So finding ways to do that, even during a recessionary period, will definitely help the company. And then also looking at the balance sheet. So doing an annual review of your assets and liabilities, and just kind of making sure that those are being used for the operations. We see a lot of companies that have what we call excess cash. So it is very healthy for a company, and it's very good for a company to distribute any excess cash on an annual basis. If you're not, if you're accumulating that cash for a potential acquisition later down the line, that would be one reason why you wouldn't distribute the cash. But if you're just accumulating cash to accumulate it, there are better investments that you could be making towards that cash that are can really help you and just kind of help streamline your business. So it's definitely a sign of health when a company is distributing.
Yeah, I was going to say, think about it as in terms of interest rates in your bank. If you're just holding the cash in your bank account, I mean, you get cents sometimes, maybe a couple dollars every month on interest. Whereas if you are distributing that and being able to invest it somewhere else, your annual returns are going to be a lot better than just your little bit of interest that you could get from just holding the account.
Yeah. So I'm going to talk about what's transferable and what's not, and why it's important to an owner. So if you're an owner and you're thinking maybe 3 to 5 years selling the business to a third party, you want to make sure that that value that is derived, that goodwill value is transferable value to the new owner. And owners or buyers want to see that that value is not going to be eroded once the sale happens. So there are two types of goodwill. One is personal and one is enterprise. And so if you are an owner and you're managing every aspect of the business, there may be potential that there is personal goodwill attributed to the company versus that enterprise goodwill. You definitely want to have enterprise goodwill. So that's that transferable value. So one of the ways to make sure that that value is transferable, bring other team members, other leaders into those client conversations. Maybe you're an owner and that you have one or two client relationships and they are really dependent on you and your personal involvement in the company, bringing along those extra leaders to help transition those relationships over, or just kind of collaborate with those key persons. We want to make sure that if you have internal processes, if you have procedures, if you have internal know-how, things like that, that if the ownership were to change in the future, that value to the new owner can be transferred easily. So having those documented in writing, making sure that they're communicated across the company, that has a way of making sure that's transferable value. And then I also wanted to talk about a buy-sell agreement. So if you're an owner and there are multiple owners in your business, making sure that you have a buy-sell agreement in place, it's well written. So some of the qualities of a well-written buy-sell agreement are you have your employment contract is included, your non-compete agreement would be potentially included for that person. And then also you want to have those steps in terms of if there's what's called a triggering event. So a triggering event is death, disability, dispute.
There's the 5: death, disability, divorce, downsizing, disagreement, or disaster.
Yeah.
And so as she's talking about the buy sell, I know we have our last poll question to ask about if y'all have a buy sell, or sometimes called a stockholders agreement. And
Yeah, and so it's one of those things, if one of those triggering events would happen, then it will specify how the company would be valued, how that stock would be valued, and also sometimes it can designate who. Generally, it's a qualified appraiser. Sometimes it can be a specific accounting firm or valuation firm. And so it's just it's a very good practice, but it helps in terms of de-risking, but also making sure that value is transferable. So what were the results of the polling question? Okay, 40% of you do have a buy-sell agreement in place, 20% don't. So if you are one of those owners, there's multiple owners, definitely it's a good idea to get in touch with a corporate attorney and making sure that that buy-sell agreement, or making sure to get a buy-sell agreement, maybe having a buy-sell agreement reviewed from time to time would be a good practice as well. So
I was going to say, just to tie it all back, all 3 of those on transferable value, they all have to do with de-risking your company.
Definitely. So some concluding thoughts and takeaways. Valuation is a tool. We love to have data points, and it's just another measurement tool for the company. And you also are able to kind of quantify those annual returns in your investment. You definitely want to just consider the opportunity to, think strategically. We've offered the valuation drivers. It's a way for you to think strategically about the business. Maybe there's one or two things that you can utilize today going forward to decrease your risk or increase your growth, whatever that is. So I hope that we've helped you today. We'll leave you with this quote from Chris Mercer. Talks about the interim time, and the interim time is the time between when you started the business or you became an owner and your eventual transition or passing the baton to that next generation. So there's definitely things that you can do between that interim time or in the interim time to provide for the successful ownership and management transitions of your business. And then with that, we'll go ahead and offer to do a question and answer time.
All righty. Thank you, Holly. Thank you, Tiffany. That was great. Looks like we have two outstanding questions. The first one, how is risk measured in the valuation exactly?
Yeah, so risk is measured generally through that discount rate. So we use a discount rate in the income approach. And the discount rate is a measurement for the return rate for a similar type of investment. So think of it as, comparing different investments. You have your treasury bonds that are pretty low risk. And then thinking of, let's say, venture capital or private equity, that's a more higher risk type of investment. So there's that risk spectrum. And also with that risk, there's also a tie to potential rewards, right? So it's tied to your potential annual returns on that.
Awesome. And then our other question, when is the best time to actually do a valuation?
So evaluation is, it's, I think it's a good opportunity to do evaluation, generally at the year end, maybe setting a time where you want to kind of do your year-end process. It's just a good idea and best practice to do, just to kind of gain insights and financial clarity regarding your company. A lot of clients do just kind of a look at their investment portfolio on a yearly basis. So if you're an owner, your investment is tied up in your business. Most of your investment is tied up in your business. So looking at that as as a personal investment definitely is a good idea to understand that value aspect of the company.